Ladies and gentlemen, good day, and welcome to the Star Health and Allied Insurance Companies Limited's Q2 and H1 FY23 earnings conference call. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and then 0 on your touchtone telephone. I now hand the conference over to Mr. Prateek Patil from Adfactors PR Investor Relations team. Thank you, and over to you, Mr. Patil.
Thank you, Inba. Good evening, everyone. From the senior management, we have with us Dr. S. Prakash, Managing Director, Mr. Anand Roy, Managing Director, Mr. Nilesh Kambli, Chief Financial Officer, and Mr. Anish Srivastava, Chief Investment Officer. Before we begin the conference call, I would like to mention that some of the statements made during the course of today's call may be forward-looking in nature, including those related to the future financial and operating performances, benefits and synergies of the company's strategies, future opportunities and growth of the market of the company's services. Further, I would like to mention that some of the statements made in today's conference may involve risk and uncertainties. Thank you, and over to you, Mr. Roy.
Thank you, Prateek, and good evening, everyone, and thank you for joining the Star Health earnings call. I will take you through a brief overview of the industry trends and developments that we have witnessed in the last few months, as well as walk you through the company's performance in terms of premium and distribution. My colleague, Dr. Prakash, will cover the financial performance and aspects related to claims, including the steps that are underway to manage them. In Q2 2023, the health insurance industry, including PA, has grown by 15.1%, driven by 18% growth in the group health and 17% growth in the retail health segment. Now we will talk about the growth and market share of Star Health Insurance. For H1 2023, our retail health growth is 21% versus industry's retail health growth of 14%. That is, we have grown 1.5 times the industry's growth rate, as you are aware, with a very large base. In Q2 2023, our retail health segment has grown by 21.7% versus the industry's retail health growth of 17%. We have grown impressively at 1.3 times the market's growth rate. Overall, our GWP grew by 11% in the Q2 of financial year 23 over the same period of last year, to rupees 3,189 crores. In Q2 of FY23, Star Health registered 34% market share in the retail health segment, which is 3 times the second largest player in the industry. We continue to grow higher than the market growth rate and increase our retail health market share. For H1 23, our retail market share is 33%, an increase of 200 basis points over the previous year same period. As far as accretion share is concerned, Star Health has registered 46% retail health accretion market share in H1 23. Our agency business continued to contribute around 82% of the overall business. Our agency strength has increased to 586,000 agents, with an addition of approximately 36,000 agents in H1 of 2023. We are on course to add about 80 to 100,000 agents in the current financial year. With improving agency productivity, we are confident of maintaining our market-leading position. For H1 23, the corporate agent segment, that is banks and other tie-ups, continues to remain strong, and our premium in this segment from this channel has grown by 44%. Some of the highlights in Q2 of FY23 for us were as follows. Regarding premium and distribution, our contribution from specialized products has increased to 16.5% in H1 23, and we continue our journey of premiumization of our product portfolio. The accretion of specialized products is 31% in the first half of the year FY23. The average sum assured of new policies has increased by 14% on a year-to-year basis to rupees 8.7 lakhs per policy. We have introduced one new product, that is Star Extra Protect, which is an add-on cover available to our existing customers. This product is available for policyholders covered under Family Health Optima insurance plan and Mediclassic insurance policy, having sum assured of 10 lakhs and above. This will enhance our product portfolio yield on an aggregate basis. We expect to tie up shortly with a South-based small finance bank, and we will announce that once the tie-up happens officially. We continue to expand our distribution reach. Happy to announce that we have opened 5 new branches in Jammu and Kashmir. We are able to achieve good premiums in the northeast regions of the country, which started about 2 years ago, and we continue to explore untapped areas and improve the health insurance penetration in India. As discussed in the previous quarterly earnings, we have exited large group health insurance policies as demonstrated by the 54% reduction in group health premium during Q2 2023. We continue to monitor this segment closely, and we will make inroads wherever risk premium is adequate. As reiterated previously, we remain positive on the SME, the small and medium enterprises, and non-employer-employee groups. The non-employer-employee segment group policies are largely sold to retail customers of the bank tie-ups which we have. And if we include these policies also, our overall retail growth is 22% in Q2 of 2023. We have recently onboarded Mukesh Sharma, a senior tech resource, as our CDTO, Chief Digital Transformation Officer. We continue to simplify our customers' journeys by focusing on digital initiatives. Some of the outcomes of the digital initiatives were our app downloads have reached 1.7 million downloads. 83% of our active agents are now using our digital solutions to provide services to the customers. Digital sourcing defined as premium collected directly from our website as well as third-party aggregators and online brokers has grown 28% year on year and now accounts for 11% of our overall GWP for H123. This is a very significant milestone as we have crossed the 10% digital business share for the first time. IBR calling bot for renewal policy retention has been introduced in Q2 of 2023. Now I request my colleague Dr. S. Prakash to talk about the claims and financial initiatives.
Thanks, Anand. Let me brief on the claims initiatives, and we are working on a 4-pronged approach to effectively manage our claim services. Number 1, prudent claim settlement based on rich medical wisdom and insurance expertise. Number 2, a well-negotiated volume-based pricing arrangement with our network hospitals, and this can give us operating leverage in terms of lowering average claim size. Number 3, technology-enabled fraud detection and mitigation tools. Number 4, risk-based pricing through micro-segmentation of portfolio. 81% of the amount settled in cashless claims during this H1 are through cashless. Cashless turnaround time during weekdays comes to around 90% for us. In cashless, we have introduced auto adjudication of claims, and this helps drastically in improving turnaround time and thereby customer satisfaction. 8% of hospitals have been onboarded under this initiative. The number of claims under auto adjudication has risen to 33,000 in Q2 FY23, a growth of 95% versus Q1 of FY23. We have stepped up our teleconsultation with 7.75 lakh consultations till date, and we are also actively promoting our wellness initiatives and programs. We continue to improve on the claims related milestones. Within overall cashless claims, the share of hospitals with pricing arrangements, that is those agreed network hospitals, the cashless claims is 66% versus 64% in FY22. Based on our market intelligence, we find our average claim size continues to remain one of the lowest in the country. In the last 3 quarters, we are seeing a consistent reduction quarter on quarter in the average claim size. As you will be aware, fraud control is one of the critical factors to address in a retail claims business. Our anti-fraud digital initiative has become operational this year, and this has started to produce savings in claims outgo. It has resulted in a 0.5% reduction in claims ratio in Q2 of FY23. We expect more than 1% reduction in claims ratio in the subsequent quarters. We are planning to take a price hike in Q3, in this quarter, in our flagship product, Family Health Optima, to combat the structural rise in medical inflation post-COVID. We have taken a price increase in one more of our product, Medi-Classic Individual, which has started showing results in the form of lowering loss ratios. Let me take you through the financial performance. Our combined ratio in the first half of this financial year has improved to 97.9% versus 119.2% in the same period last year. Improvement in combined ratio is achieved through claims and expense ratio management. The combined ratio in Q2 FY23 was 97.9% versus 117.3% in Q2 FY22. The claims ratio in H1 FY23 has improved to 67.3 versus 88.2 in H1 FY22. H1 FY23 claims ratio has 0.7% impact on COVID claims. The claims ratio in Q2 FY23 was 68.2% versus 85.6 in Q2 FY22. This year, with staggered monsoons, the impact of epidemics like dengue, malaria, viral fever, this was high in Q2 of FY23 compared to historical averages. We have seen a 9% decrease in reported claims in October 22 versus the average of reported claims in Q2 this year. While usually Q3 is prone for epidemic-related claims, so far in these 40 days of Q3, we have not seen any major impacts. For the month of October, the loss ratio is approximately 63.5%, and the YTD loss ratio as on October end is approximately 66.5%. So we are very positive and confident to achieve the loss ratio as per the guidance given for the financial year. Expense ratio has also improved in H1 to 30.7% on account of efficient cost management, evidenced by a fall in expense ratio in Q2 FY23 to 29.7% from what was 31.6% in Q2 FY22. There is a 1.9% improvement. So H1 FY23 recorded a profit before tax of rupees 409 crore and profit after tax of rupees 306 crore. Adjusted profit after tax, excluding non-business ESOP cost, is rupees 390 crores in H1 FY23. For the Q2 of FY23, the profit before tax is 121 crore and profit after tax is rupees 93 crore. Our investment assets have grown to rupees 11,653 crore in H1 2023 versus rupees 8,604 crore in H1 2022. Claims-based solvency as on 30th September 2022 is 1.95x compared to the regulatory requirement of 1.50x. This solvency is achieved through only mandatory 4% reinsurance arrangement that we have. We have repaid a sub-debt of rupees 200 crore before 30th September 22 and another rupees 50 crores in October 22. In spite of payment of the sub-debt, the solvency continues to be well above the required level. To conclude, ladies and gentlemen, we continue to believe in the profitable growth opportunities available in retail health segment, and we are on our desired path of realizing the same. Thank you.
So may we open the lines for questions now?
Yes.
Thank you. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may enter star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who has a question may enter star and 1. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question comes from the line of Swarnam Mukherjee from B&K Securities. Please go ahead.
Yeah, good afternoon, sirs, and thank you for the opportunity. So I have 3 questions. First, on the loss ratio side, so as you mentioned that Q2 was impacted by epidemic-related diseases like dengue, malaria, and in the first half, our loss ratio is almost around 68%. Now, this number that you have mentioned for October 63.5, if I heard it correctly, does this also have a COVID element that you had disclosed in for first half? And then I believe that you will have to maintain this kind of run rate for the next of the year in order to reach your 63 to 65% guidance. That I mean, if that is the case, then is there then does that again include a structural element that you were saying that is happening in the post-COVID world in terms of
Hello, have you? It's not audible to us. Hello?
So let me check. Give me a moment. Yeah, Mrs. Swarnam Mukherjee, are you still there?
Yeah, I'm there.
You can please.
Can you hear me?
Yeah, can you repeat the last part of your question? I think the management was unable to hear.
Okay, sir. So, did you get the question on the loss ratio, sir?
Can you just repeat the whole thing again?
Yeah, sure. So, sir, in terms of loss ratio in first half, you have the number was almost around close to 68%. Now the 63.5% run rate that you have said for October, I guess you will have to maintain that kind of run rate to reach your 63 to 65% kind of guidance range that you have given. So, how confident are you about that? And does this also factor in the structural changes towards the loss ratio, slightly elevated loss ratio in the post-COVID world? So that was the first question. Was I audible, sir?
Yeah, we are audible. Can we take this question first then?
Yes, sure, sir.
So in the first half, particularly during July, August, the reported claims on infections due to fever and respiratory illness were very high. That's probably because of the southwest monsoon. And we usually get this impact of monsoon during October and November. But this year we saw the maximum impact of monsoon in July, August. So based on that, we have a feeling that the worst of the impact due to the pandemic, due to the epidemics of monsoon, have already happened in the Q2. So that's the reason why we say in Q3, in the 40 days of this Q3, where usually these days are prone for monsoon-related epidemic diseases. We don't see so much of epidemic diseases during this 40 days in this Q3. And that's the reason why I'm showing a lot of confidence that we should be able to reach where we have guided towards the end of this year.
Okay. So the thing that I also noticed was that your share of cashless claims through the network hospitals have gone up. Does that in any way positively impact the loss ratio? Or how should we look into that, because that did not pan out in the numbers? So just wanted to know.
In general, I can say more the cashless, it is more comfortable to the customer and also less prone for fraud and unwarranted claims, because we are able to ascertain and get all the details. We know the infrastructure and the expertise available in the hospital. We have empaneled these hospitals, and we know what are the systems and process, and we have a score of their performance also. So based on these things, as much as we get more traffic and more outgo on cashless related hospitals, we feel that we are giving no rooms for unwarranted and unindicated claims.
Yeah. So, if in your internal calculations, do you see a difference between the loss ratio from these hospitals where cashless is more vis-a-vis others?
See, not all hospitals are the same. We categorize hospitals, the geographies, their bed strength, and the level of expertise. So we have different grading of hospitals, and then we monitor the outgo based on the average that we pay in that area. If there is an index price, it's a complex process that we follow. And based on all that, we ascertain that we pay less than what the hospital otherwise charges in that area for a particular procedure.
Okay. And sir, next question on the retail health renewal ratio. So wanted to understand, we were at a number of 98% in FY21. I understand that in the COVID period, there were Corona Kavach policies, etc., which resulted in, which were not renewed. So last year, the numbers were not at that level. But this year, I think we don't have such kind of policies in the base. But still, the renewal rates are, in and around 94%. So how to look into this, and is there any persistency in any kind of cohorts? How should we look at this?
Yeah. The retail renewal ratio continues to be the best in the industry as far as retail health insurance business is concerned at 94.4%. But there were some policies which were taken last year due to the fear of COVID, not COVID related policies, but some customers had taken some top-up policies which were not renewed this year. But we are not much concerned about this. We are very confident that we'll be able to maintain a good renewal ratios, and it will be improving every quarter.
Okay. In terms of renewals, as we progress generally in the renewal cohorts, will our loss ratios kind of increase because age of the customer increases, and then there could be probability of claims?
So you have to we look at it on a combined ratio basis as the renewal cohorts age. So on a combined ratio basis, we are able to maintain profitability at all the cohorts as far as our customer base is concerned. And whenever it is required, we do go for a price revision, as already Dr. Prakash had mentioned in his presentation.
Mm-hmm. Sure. And one last question from my side. Sir, you mentioned in the opening comments about the SME book continuing to be the focus area, but the number was a bit muted in that front for this quarter, and even for the last quarter. I think single-digit degrowth was there. So what is going on there, if you could highlight?
Oh yes, the focus in the group segment is on the SME business, but even within the SME business, the company is very, very selective in terms of our pricing strategy and underwriting principles. So we are, even in the SME business, we want to be selective. So there has been a little slow growth, but we are confident of the target that we have taken for the current year, and we will achieve that.
Okay, that's helpful, sir. Thank you so much, and all the best for second.
Thank you.
Thank you. Ladies and gentlemen, we would request you to please limit your questions to two per participant so that all participants may get an equal opportunity to ask questions. We'll take a next question from the line of Prayesh Jain from Motilal Oswal. Please go ahead.
Yeah, hi. Good evening, everyone. Firstly, could you tell me as to, our investment book has grown, the yields have are higher sequentially for the entire industry, but still we saw our investment income being flattish on a sequential basis. How do we read that?
If you compare it with respect to the last financial year, there was a profit that we booked in first half of last financial year, approximately 110 crores of profit that we had booked. And in full year last, we have booked the profit of approximately 160 crores. And the reason was that yields were at the bottom, and hence we decided that perhaps it would be an appropriate strategy to do that. So it was a tactical move which we did, and hence because of high base of last year, you are seeing the flatter base this year. Otherwise, we are maintaining the yields of the portfolio.
My question was more on a sequential quarter basis, Q1 versus Q2. Q2 versus Q1.
So I understand your point. See, what happens is that a large part of the AUM growth actually happens in the second half of the financial year. And since AUM remains flat, and there is no incremental deployment which is happening except for what we get in maturities, so basically yields ultimately remain broadly the same. But we would be in position to take the benefit of rising yields in the second half of the year as we start getting larger flows. And obviously, as mentioned here, we have paid back some 250 crores of sub-debt as well.
Okay.
So that is how the calculation goes.
All right. And what is the quantum of price hike that you are contemplating, and is it the only price hike or some other price hikes are also being considered? And when you say you will be able to maintain the 63.5% kind of October level loss ratio, do you include the price hike in that when you say, or how do we read this in terms of outlook?
We are continuously monitoring product-wise loss ratios, and when they cross a threshold, we go for a price revision. And at every product level, we want to maintain profitability. And that's how the whole management works on that concept. So any product, when we find that it crosses a threshold, we go in, we study the reason, and then we find an alternate solution by repricing the product. And also currently, we are selling more and more of high sum-insured policies. Our fresh policy sale, close to 82% is 5 lakh and above. So there is a tremendous increase quarter on quarter on the sale of high sum-insured policies in our fresh. These, along with the price revisions that we do, and the age band where there is a premium hike based on the age band, and some of our customers enhance the sum insured. This post-COVID, we see a lot of people enhancing the sum insured during renewal. All these things contribute to our premium growth.
Okay. I'll just slip in one more question. If you look at your claims, what would be your claims filed versus claims delivered or claims settled? What would be that ratio, and how would have that trended in the past, year or so?
The claims filed, we call it the claims reported. We see that close to 83% of the claims reported were the claims that are incurred by us. And this consistently continues the last 7 months of this year. We don't see any volatility in that.
No, so my question is coming from whether this 83% that you're saying, is it in line with what the industry is doing? Is it better than the industry? Or we are at the lower end? Is there a trend where the other players are able to get more market share out of this?
So we don't have public disclosure on these, infra details. But overall, the number of claims reported will depend on the type of portfolios the companies handle and the business model.
Sorry to interrupt, Mr. Prayesh Jain. May we request you to return to the queue? There are several participants waiting for their turn. We will take our next question. That's from the line of Jayant Kharote from Credit Suisse. Please go ahead.
Yeah, thank you for the opportunity and congrats on good set on the growth, sir. I have a couple of questions. Firstly, on the reserving, you could break the URR into retail and corporate and also sort of give some color on this bit of higher reserving this quarter. Then I'll take the next question.
Yeah. So in terms of group, because we are degrowing, we have been degrown to almost 50%. The earned premium is higher than the net return premium. So the reserve release is higher compared to the creation that happens. Whereas in the retail, last year also we had grown by 22%. We continue to grow at 20%. So the reserve creation and the reserve release continue to match. So when we talk about the net return premium being lower than the net earned premium, it is largely because of the group health business where we have degrown.
Okay. So on the retail side, if you could break down the growth into volume versus value, that would be helpful.
8 to 10% of our growth is value based and around again same 10 to 12% is volume based growth. The split of 21% that we have.
Now in the second half, sir, some of the impact of the price hikes would be already coming into the base. So do we expect, typically for us, is the second half more heavy on the volumes than the first?
Yeah, definitely. So Q4 being a tax exemption period, that is where the majority of the volume comes in and it should be good. I mean, first half because the base was higher, we see a slight base effect coming into play for first half, but second half we believe should be good.
Yeah, so two last questions. First is on the median age. You had disclosed last time around the median age moving lower with the Youngstar product penetration increasing. So if you could talk a little bit about how the penetration of Youngstar product is currently at, I think it was around 11 or 12% last quarter, and how is the median age moved QOQ?
So the median age continues to be 41 years as we speak. The Youngstar product is doing well. It is one of our fastest selling product. So there is not, the median age hasn't changed much.
Does the Youngstar grow faster than the overall retail growth, meaning the share in the mix, is it moving up or stable?
Of course, because it is also coming up from a relatively lower base, so the growth is faster and it is also very attractive to the younger age profile of customers. So definitely it is growing at a faster pace as compared to the overall growth, retail growth of the organization. Okay, sir. Thank you very much.
Thank you.
Thank you. Our next question is from the line of Avinash from Emkay Global. Please go ahead.
Yeah, hi. Good afternoon. Again, delving a bit on, claims and combined. So several factors that have helped it improving versus last year. Of course, no COVID. Then you have steered your portfolio more towards retail. You have done kind of upselling and selling more specialist product. All these factors and of course could have helped you. But again, the vector-borne diseases and sustained medical inflation that is acting against. But these factors are kind of part and parcel of the business. I mean, sometimes it will be dengue, malaria, or other times chikungunya, diarrhea, whatever. Now the question here is that at this juncture, because almost we are 8 months, are you still sort of comfortable, if not the lower, the upper end, like a 65% kind of a claims ratio and a 95% kind of a combined ratio for FY23? I am asking particularly 23 because many of the steps in terms of price hike and other things you will take may sort of bear fruit in FY24, but FY23 we are like almost 8 months into it. So the first question would be, okay, how much comfort do you have around the 65% claims and 95 combined ratio for FY23? And then following on that, what sort of growth now, because your portfolio steering is done, group retail, for FY24, what kind of a growth sort of, a top line growth you will be seeing? So these are my two questions. Thank you.
loss ratio, as spoken by Dr. Prakash during the script reading, we continue to maintain the guidance of 60 to 65%. And, as spoken that some of the Q3 impact has already come in Q2 in terms of the epidemics that have come in. Q4 last year, if you see, excluding the COVID loss ratio, it was 64% with a higher weightage of group health. So, and Q4 traditionally has been much better than the first 9 months or quarter 2, quarter 3. So we are pretty confident of the full year guidance that we've given in terms of the loss ratio of 63 to 65%. In terms of growth, again, H1 was around 12%. Avinash, you were talking about the next year growth or the second half growth?
No. I'm next year, because this year I am sort of understanding you shuffling between, group to retail. I am saying that, okay, now say FY23, you achieve the portfolio where you want to in terms of mix. Now, what kind of growth would you expect in next year? Because now your portfolio balancing is done. Because this year, of course, your growth is being hurt by portfolio balancing exercise. So I am saying that next year you will be taking certain price hikes. Your portfolio base impact is there between group and retail. So what kind of a growth you see for FY24?
Yeah. So with the group base effect going out and with price increases and with a large base, we believe we should be in a position to grow on at 20 to 22% going forward.
Okay. And so if you are kind of still confident of a 63-65% claims ratio, that means a kind of a 95% combined ratio is also on target. I mean, a 30% ballpark expense ratio is correct?
Yeah. So, I mean, for quarter 2, the expense ratio is slightly below 30%, but yes, I mean, we continue with the guidance of 93 to 95% combined ratio and 63 to 65% loss ratio.
Okay. In terms of just quickly on solvency, because I mean solvency will continue to improve because still you have deferred tax effect, so it will improve even faster. So, and growth being sort of a control. So, do you see again a further scope to reduce your sub debt, or like what kind of capital? Because I mean, most likely you are going to end up the year around 210% solvency. So, will you continue with the sub debt, or you will sort of exercise some call option others?
Yeah, so the solvency continues to be strong. It is still on claim basis at 1.95. If we take on premium basis, the solvency will improve to 2.08 times. In terms of sub-debt, the sub-debt that is issued is for 7 years with a call option after 5 years. So this sub-debt which we had issued in 2017 came up for call option now, which we retired. The 470 crores that we have raised last year in September, it will come up for call option after 5 years. So, and conditions will be not in a position to exercise the call option or call for this sub-debt before the due date. So we'll continue with the sub-debt, and it's efficient. It's at 8.75% interest rate.
Mr. Avinash, could you please return to the queue so that we can ask other participants?
Yeah, sure. Thanks.
Thank you. We'll take a next question from the line of Shreya Shavani from CLSA. Please go ahead.
Thank you. So I have 2 questions. First is on the commission rate. So I can see that if I see for second quarter, the commission per net written premium is slightly lower at around 13%. It used to be at 13.7 or 14% previously. So has any change happened over there? Also, the second question is on the reinsurance. Your reinsurance is also reduced to under 5% now. I know that the mandatory level has been reduced to 4. So any comments you'd like to highlight? Any change in reinsurance agreement now that it's a different 4% mandatory limit? So those are my 2 questions.
Yeah. So commission, structurally there is no change, but the business composition also impacts the commission ratio. So as Anand sir spoke that, the direct portion has now grown to 11% of the overall business. So on a portfolio basis, it has an impact on the commission and, the composition of new as well. So last year, it was a high growth period in retail where the overall output is 19.5% on agency business. So this year the growth is around 20%. So changing business mix portfolio, it has impacted the commission ratio. In terms of RI, the mandatory RI is reduced to 4% now. What we have is the personal accident and critical illness benefit products, where we have specific reinsurance arrangement. We had spoken on the last call that this portfolio is also growing for us. So on a portfolio basis, it is in that range of around 5% still, even though the obligatory is at 4%.
So excluding the personal accident, the normal your health policy where your mandatory is reduced to 4%, the terms of agreement with the reinsurer remains the same.
Yeah. So these are this is the reinsurance with GIC Re, and it's standard terms across the industry. So.
Oh, okay.
Yeah.
Got it. Thank you. Those are my questions.
Thank you. Our next question is from the line of Sahej Mittal of HDFC Securities. Please go ahead.
Hi, good evening, everyone. So, three questions from my side. So, firstly, what percentage of your existing customers are opting for an upsell or a higher sum assured on the existing policy? If you could quantify that and give some color around, what are the type of these customers, what kind of higher sum assured they are going for. Say, for example, earlier they had a policy with a sum assured of, say, 10 lakhs. Now they are opting for 20 lakhs. Or any signs wherein customers are actually going for a reduced sum assured. That is first. Second is around other expenses other than the related to the insurance business. So, I mean, that has already reached close to about 150 crores in the first half. So, are we done with the expenses related to ESOPs to the CEO, or are we expecting any further expenses in this line item? Those are the first two questions.
Yeah, as far as upselling of renewal customers are concerned, we have a dedicated team which is focusing on renewal retention, and we pride ourselves that we have amongst the best renewal retention in the entire industry, and consistently so for the last 15 years. So upselling is a strategy that we follow, but the company also has a strategy to upsell only to customers where we see profitability once we upsell. Obviously, that is an internal strategy that we adopt. So we have a plan and we continue to do that, but we are not disclosing this number in the open forum. Maybe we can take it offline and we can discuss this with you. As far as the ESOP cost is concerned, I think we have 2 more months, that is October and November. Cost will be absorbed, and after that I think the entire 100% of the cost gets absorbed.
Sorry sir, if you can just clarify on the ESOP front.
So ESOP, 10 months are over as on 30th September. 2 more months remain before this whole cost will be absorbed. So for October and November there will be an additional impact of 36 crores which will come through, that will close the matter in terms of the ESOP cost. It started on 1st December, it will end on 30th November.
Right, and one thing is on the restating which is done by Star Health when you're reporting the monthly numbers. So, I mean, after restating the base numbers, your growth optically looks better, right? But being a market leader, this sort of raised doubts for us. So, if you could give us a convincing explanation for the restatement in the base, I mean, what was that relating to?
Yeah. So, Sahej, there is no restatement in the base. If you look at the financial quarter-end numbers and what we're reporting, it is always in line. It is only that since inception we are following basis the transaction date, because we follow 64 VB, the cash before cover. The money comes in before the policy starts. So, during month ends, the first day premium used to come on 29th, 30th, which used to get booked in the system and reported, because we did a reporting from the system, which method we have changed last year. December. So that is also a 1-year impact which will get over, I think, in December.
Risk commencement date.
Risk commencement date basis is what reporting we have started, which was always there when we reported financials. So it's only a monthly phenomenon. Quarter end numbers were always in line with what we report in the financials.
Right, and I was just taking a look at the balance sheet, and there's been a degrowth in the provisions. So ideally, if the business is growing, then the provisions for a general insurance company should grow because of higher unexpired risks. I'm not sure if I'm reading this correctly. Correct me if I'm wrong.
So the unexpired risk follows a pattern. If you see compared to Q1, the Q2 unexpired risk has grown. we always say that this is a retail business which happens more in quarter four. So compared to quarter four is the maximum quarter where the risk gets, the reserve gets created in terms of the URR, unexpired risk reserve, which keeps on releasing. So 1/365 pattern will always be in line with the premium which happens during the year.
Sure. Thanks. I'll join back with you.
Thank you. Our next question is from the line of Sanket Godha from Spark Capital. Please go ahead.
Thank you for the opportunity. Sir, just if I take the renewal rate of 94% and try to calculate the breakup into new and renewal, then it seems that the new business has declined for us in first half of FY23. Is that assessment right, sir? So just wanted to understand that despite taking price hikes and everything, the new business becoming degrowing in the current year. And probably is it the high base which is leading to that thing, basically?
So Sanket, for the first half of the year, we have seen a flattish growth in new business, and as rightly put by you, it is because of the high base of the last financial year where the Delta variant had a huge impact and led to a very enormous growth in the health insurance business last year. But as we speak, when we are looking at the trends for the last 3 months, we are seeing a positive, very high positive growth, and we believe that by the end of the year, we will end this year with a very, very good performance in new business also.
So is it safe to assume, sir, that maybe a mid-teen growth or a low-teen growth at least is possible for the full year in new business, not factoring the new renewal part?
Sorry, can you repeat?
Sanket, your voice is not clear.
Sir, I was asking that given the trend has improved from because fourth quarter is seasonally strong, is it safe to assume that by end of the year the new business growth would be in mid-teens or low teens compared to the flat trend what we see for the half?
Yes, you can safely assume that it will be in the mid-teens, if not higher.
Got it, sir. And sir, so the second question which I have is that given the contribution of the specialized products have increased to us, I just wanted to understand how the loss ratio of specialized products look versus the regular product or the company average. How different they are, how substantially lower they are, and just wanted to understand the trend that the specialized products which are currently around 16.5 of the total GWP in first half. What is the likely number you want to target that to have a cushioning effect to the entire loss ratio?
Yeah, Sanket, the specialized products are really doing well. There's a lot of acceptance from the market, and our outgo is also relatively less compared to our other retail products. So we are comfortable and we continue to accelerate our sales in the specialty product, and we expect a 10% cushion on the ICR and specialty products compared to other products.
So if I understood it rightly, given in 1H we have a loss ratio of 67.3, is it safe to assume that the specialized products have somewhere mid-50s as a loss ratio?
I think,
See, what we have seen, that the GWP is growing. The earned premium catch-up will happen over a period of time. So,
okay.
So no, you cannot put it in proportion to the GWP rise. That way.
Okay, sir. And the last one, the quantum of price hike you have taken in Optima and the MediClassic. I just wanted to understand what is the quantum of price hike it will be, and what proportion these two products will contribute to the entire retail health portfolio of ours.
So we have taken a price hike already in our MediClassic insurance, which is individual plan, which constitutes around 7 to 8% of our GWP. We have taken a 24% price hike in that particular product only a couple of months ago, so the price hike will still take some time to play out. We are evaluating a price hike in our family health Optima, which is our flagship product, which constitutes close to 50% of our business. And we will get back to you with details once we have some clarity on that.
Okay, perfect, sir. Thank you. That's it from my side.
Thank you.
Thank you.
Thank you. Our next question is from the line of Anshuman Deb from ICICI Securities. Please go ahead.
Yeah, good evening and thanks for the opportunity. So the first question is regarding the expense ratio, as it has gone down quarter on quarter. And so is there an arbitrage that we are likely to see versus our peers, considering the scale that we have right now, in a little bit more control in the expense ratio? That is one number one question. And the second question is that, despite a higher retail mix and the price hike, and also targeting some of the newer, lower age people, our loss ratios have increased because of the timing of monsoon, as you said. So does your 63 to 65% guidance factors the effect of this, price hikes coming in, plus the mix improving, also, the kind of mix? These are the two questions.
So, in terms of expense ratio, our investment in technology, efficient processes, continue to yield us results, and this is one of the best-in-class expense ratio when we compare to peers doing retail business. And we believe, we should be in a position to take these benefits as we keep on moving forward. Your second question on the impact of loss ratio due to price increase, what will happen is Medi-Classic was taken in July 22 with a 24% increase. That will definitely have an impact on the year-end loss ratio. When we talk about the other product which will be effective hopefully in December, it will first start for the new product for 3 months and then it will start for the renewable product. So the large benefit of it will come only in the next financial year. This financial year, it will be hardly anything when we take this in December. But yeah, in spite of that, we are confident of maintaining the full year guidance of 63 to 65%.
Right. So, no, my question in the loss ratio angle is that the hikes or the strategy that we are taking in terms of mix, etc., should have some positive effect, right? So, it will balance the inflation, or what is your view? What is the management's view on the inflation versus the inflation and versus the strategy that we are taking to counter the loss ratio?
See, the price hike that we take, is considering inflation for the next 2 to 3 years. We don't want to go to the market with frequent price increases. Any price increase that we take should at least be effective for 2.5, 3 years. So that's the approach that we take.
Okay. Thanks a lot. Thank you.
Thank you. Our next question is from the line of Anand from White Oak. Please go ahead.
Thank you for the opportunity. I have two questions. One is, from our investment book perspective, what is the typical duration do we aim to maintain and what's the current duration? That is first. And second, there's a change in our outstanding claims of 60 crore. Now, if I were to use the previous quarter's stock of outstanding claim, this comes to around 6%. So there's been a 6% kind of outstanding claim reserve release. What is driving this? If you can give some color.
So, Anand, as far as duration is concerned, broadly we are somewhere close to 4.2 years on modified duration terms. And depending on the market conditions, we will marginally adjust. With rising yields, maybe that we would look at it as a favorable opportunity for us to look at some duration. But overall portfolio, 4.2 years is what the duration is.
Sure. And the question on release of outstanding claim reserve?
Yeah. As Dr. Prakash said in the script that the proportion of cashless claims is increasing. So, as the proportion of cashless claims increasing, the settlement is much faster, and hence the outstanding claim gets reduced. Second thing is the delay that we are seeing previously last year because of COVID and other things, delays, and there were more of reimbursement claims. That trend is also coming down. We see more of cashless claims coming in, and the delay in reporting is also much lower. So that both these factors have led to a marginal reduction in the outstanding claims.
Okay, so just wondering, in case of this improvement, given we are consistently improving technology, so you consistently expect this claim reserves to get released due to this improvements in quicker reporting and more cashless claims? Is that a trend we should expect on an ongoing basis?
No. See, it depends on multiple factors. So now, quarter 3 and quarter 4, it's a function of the loss ratio also. If the whole proportion itself is reducing in terms of the lower loss ratio, then the claim outstanding will also reduce. It's a function of the cashless settlement of claims, the efficiency, the auto adjudication of claims, because it is happening through the system, which is much faster. So we'll have to look at the quantum of business, the growth in business, the cashless settlement, the delay in reporting. All these factors will contribute to the outstanding claims. It's not a static number. It is driven by 4 or 5 factors.
If I were to summarize, you mean that the 60 crore has been released because now we don't have to make as many estimates as we had to make in the past, and because of quicker processing and quicker cashless disbursals, we are our provisions are more than we had expected, and hence we are releasing. Is my understanding correct?
Correct. That's it.
Okay. Thank you.
Thank you. Our next question is from the line of Neeraj Toshniwal from UBS India. Please go ahead.
Hello. A few data keeping questions. I just wanted to know, within digital, we have grown 28%. What would be the contribution from own channel, and what rate would that have grown? That is first. Second, if we can have split between rural and urban growth. Is rural going faster due to CSC tie-up? Just wanted to get some sense whether that is helping, because we did tie-up in the last quarter. And third would be if you can have claim ratio split between retail health and the group health. That would be helpful.
So as far as the contribution of our rural vertical is concerned, it is definitely growing much faster because these are relatively newer channels. Obviously, there is a smaller base. So we are growing at more than 60%, 60 to 70% in the rural insurance. But it is still work in progress. There are a lot of opportunities out there, and we are still exploring various new locations to open our, satellite offices, so that we can increase the penetration in the rural areas. We have also signed up more than close to 3,000 hospitals to service our rural customers in these markets. So that agenda is being pursued quite aggressively. And as far as the loss ratio split between group health and retail health is, we are not disclosing that in the public domain. So unfortunately can't reveal it here, but probably you can take that offline with us whenever you feel.
Digital split. And one more question on the digital, the contribution own channel and the third party and the kind of growth we have seen.
Okay, so it is 70% own channel and 30% partnerships. Our focus is on growing our direct digital piece more aggressively. We have a fantastic team which is working on that, and improving our direct business. But we do have some partnerships, and they are also doing well for us. So overall basis, we see a higher growth coming from our direct digital piece and a relatively lower growth from the partnership piece, if that answers.
Can we quantify if it's handy?
Okay, 70% is a contribution. As far as growth is concerned, I would say the direct piece is growing 10% faster than the partnership piece.
Okay, got it. And on one of the answers in the previous participant, I think you mentioned that you will be taking price hike on the family Optima product in coming months. I think last call probably we mentioned that we have launched a new product similar on upgraded product Star Health Assure, and that would have taken care of the better pricing and better features. So are we looking to again launch a new product over Star Health Assure, or is this the totally different price increase?
The regulations as it stands today do not allow you to change the product features when you're taking a price hike. You can just take a price hike depending on the performance of the product. So that's what we are doing as far as our Family Health Optima is concerned. The features will remain the same. it will only be a premium rate revision given the dynamics of the product. Star Health Assure, as mentioned by you, is a fantastic product and is doing extremely well. That will continue to remain, as it is. It is only the Family Health Optima that is undergoing a price increase.
Got it. That is helpful. Thank you.
Thank you.
Thank you. Ladies and gentlemen, we take that as a last question. I now hand the floor back to Mr. Nilesh Kamli for closing comments. Over to you, sir.
Yeah. So thank you for taking the time today for attending the call, and we are confident of the guidance that we have given, and we'll achieve our results as per the guidance. Thank you very much.
Thank you, members of the management. Ladies and gentlemen, on behalf of Star Health and Allied Insurance Company Limited, that concludes this conference. Thank you for joining us,